Starters, you're very good at kind of looking at the action across stocks and bonds and other asset classes to try to get a fuller sense of what's going on here. What are your latest thoughts on all of these moves?
Well, I think, Kelly, that today we're seeing a little evidence of some of the illiquidity problems are calming down a little bit. Rick just mentioned the dollar finally rolled over after a spike. The bond yield was up to almost 10-year to 1.25% here earlier in the week, and it's back down again. There was evidence of illiquidity there. The muni market was showing it. Swap spreads have improved. So there's a number of things where you're seeing some evidence that the Fed dramatic and massive actions are starting to work a little bit. I also think personally that I think the bond yield backing up is a little bit of a good thing because I think it suggests that the massive buying of bonds by panic investors might be receding a little bit, allowing yields to lift, if you will. And I think I agree with Rick. If we push that 10-year yield back below 50 basis points, it's going to add to the fear, Kelly, that's already out there rather than reduce it. So I actually think that's a fairly favorable sign.
So how do you think through everything that's coming at us, Jim, from the central bank and from the government? Is all of this stimulus, all of this liquidity helping the market to find a bottom and ultimately the economy? Because let me tell you something. When I see Goldman Sachs saying that second quarter GDP is going to be down 24% annualized, you think we have a huge challenge to meet.
Well, one thing I've thought about, Kelly, is that this is the only recession by proclamation we've ever had in our history. Usually recessions occur because of vulnerabilities in the economy that tip. And they happen more slowly where the data starts coming out bad and the stock market wonders if it's a slowdown or recession, and the bear market sort of stretches on. This one was the quickest to bear ever in our history, where it dropped 20% quicker than any other. And I think it was because everyone knows we're headed to recession. It's not a debate. We did a recession here by mandate. We just decided to shut everything down, and we're going to recess for sure. And so the market got there to a recession case very quickly. And what my point about that is even if we now have a recession, I'm not sure there has to be a lot more downside in the market because it very quickly has already discounted a lot of that. Now, if it's longer than expected, that certainly would create more downside. But if we have a 1 or 2 quarter very deep contraction and then a recovery, I'm not so sure the markets don't already price a lot of that in.
And so let me bring in John on that note, which, again, this has been an unusual one because the stop in the economy and in the stock market happened almost coincidentally, John. So what does that tell us as we start to look ahead towards a recovery? Can we discount one? Can stocks price in what they think might be better news 6 months out, or will we just have to wait and see and take it day by day?
Well, we think we'll likely have to take it day by day, and it'll be around what treatment is offered for coronavirus. In our view, we're at the count stage. We're trying to have the containment stage. Now we're looking forward to the treatment stage. And to echo Jim's comments, we may have 1 or 2 sharp quarters downwards, but when markets come back with the economy, it may be as violent as when they went down. That's what we want to make sure that our clients are participating in.
Explain what that could look like, because typically, John, when we talk about downturns, a V-shaped recovery is great news. A V-shaped recovery here could be a huge challenge of its own, right?
Yes, oh, definitely. Given the closures we're seeing hour by hour now across the country and state by state, so that will challenge the V-shape. In our view, economically, to us, I'll go back to the treatment. Is we all know this is a health crisis first, economic second. But we still give better than 50-50 odds that we will come back third and fourth quarter from our economic team. Stocks will generally get ahead of that. As Jim said, we've already discounted the average recession almost at this point. The panic selling seems to be calming, evident by some buying in the bond market today, some buying in gold today, and stocks being volatile. So it is a day-by-day, Kelly, as you mentioned. We hope for a V. We probably plan for a U, but we want to make sure we're invested through that.
All right, fair enough. Guys, thanks.